Okay, this is going to be a continuation of the prior video I made. I want to see something real quick. So anyways, in the prior video, somewhere over here, I was talking about the dangers of scaling in when you're in a free-falling market. And this is pretty much what this is. And the reason it's dangerous is, number one, your risk can grow extremely quickly. And number two is you may get slippage. There's always the risk of whenever you see a big sell-off like this, there's always that risk of, some giant breakout where you may think that, hey, worst case we fall, 37.22. Well, what if, who knows, you get a market crash or a flash crash or some sort of broker issue and you have an issue with your stop. Now, there's always that risk, but it's significantly increased when you're free falling. And if you see even right here, look how much further down we went. And even right here, you look and think, I'm talking about right here. Next thing you know, okay, here's the bottom. And right here was 37.30, here's 36.98. Well, here's the true bottom. Pretty much 36.55. So it fell another 40 points from all the way over here. So that's why it's really dangerous. And that's why I said you should use options in that kind of situation when you're not sure of how the market looks. Over here, that's one thing. And really it's still better to probably use options, but over here, fair breakout, found buyers. Well, guess what? There's not a huge amount of risk compared to what we just looked at, buying these lows, buying this breakout, and really even buying these breakouts. Not near as much compared to a market like this that just keeps going down and down and down. So overall with the day, let me adjust the chart real quick. Overall, coming into the day, you had consecutive buy climaxes, 1, 2, 3, 4, and gap up. So the odds are it's a swing short, risk is big, but probably going to test the moving average. So you sell, stop above here. Strong breakout bar, probably at least strong enough for a second leg down, but your stop's up here. You can call it a failed breakout. However, this is probably not strong enough to erase this. So best the bulls can reasonably expect is probably sideways. Low one short, but a bull bar. Big tail. However, again, bulls still need some sort of bull bar. Bears got the minimum follow through. They got another follow through bar, so probably at least second leg down. And we're collapsing. So here we have a high one buy or failed breakout, but it's a micro channel after 1, 2, 3, 4, 5, 6, 7, 8, and 9. 10 bars. Probably the first slope will fail and we'll go sideways, so not a great buy. If anything, it's probably better to sell, but it's certainly okay to take profits. The stop's fairly far away. Maybe your stop, if you sell here, maybe your stop's up here, better if it's up here. And you can see what happened, double top here and here, fair breakout, and a follow through bar. And okay, so once as I said, no reason to get out here. It's really you stay short. If traders get out, hard to get back in. So that's why it's probably better for most traders if they take part off. If they can at least trade 2 contracts, maybe they sell and then get out above here, 1 contract, stay short the second, and you get out above the bull bar. So probably get out there. And in terms of, do you have to get short again here? I would not. For me, I really don't like to get short when you've been away from the moving average for this many bars, and especially when it's this climactic. That's a really hard thing to do, to sell down here when it's the furthest we've been from the moving average in a fairly climactic move. So, and the problem is stop placement. If you sell here, your minimum stop's here, and that's not really a great stop, because if it goes to here, it's probably trading range, and we'll probably sell off. So what that means is I expect price to get somewhat tested up here. And, again, you can sell any of these closes and you get out of a bull bar. So if you at this point, it's probably sell the close, certainly sell the close here. But the problem you have is sell the close usually doesn't last, maybe last 5 bars or 6 bars. However, you've got to add into the fact of here, 1, 2, 3, 4, 5, 6 consecutive bear bars, 7 consecutive bear bars. Are you going to get an 8th consecutive bear bar? What about a 9th consecutive bear bar? At some point, you're going to get a bull bar. And it's probably best to take profits above that bar. So there's a bull bar, but strong enough. Probably need a second entry buy. Certainly okay to get out of longs or shorts, excuse me. And you can see bulls, 3 consecutive bars. Bears trying to get up somewhere around break even. And bears were able to sell the close and get out, so they could sell the close, sell more, and get out. So what do always in bulls do? They can buy here, stop down here for a swing up to these highs, but it's probably a swing buy. And you can see we keep getting consecutive bull bars. First versatile down should fail, always in long, tight channel. Once again, minor high or low, so now you have a double bottom. So bear breakout, but with a follow through look, and it's not a breakout of here. Bad follow through, so now it's a double bottom with here and here. If a bear got out, if a bull got out, they probably buy again here. Second entry short, but always in long. Probably the best the bears can expect is a trading range. And we get another bull bar. And there you go. So, what is it? Is it a wedge? Is this a wedge? Is this a failed breakout of a wedge? 1, 2, 3, bear breakout. Who knows? Maybe this reset the count. 1, 2, 3 with the bull breakout. One thing you have to think about also is consecutive sell climaxes here, 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 and here. You expect 10 bars and 2 legs sideways to up. This is probably not one, leg 2. So in other words, first leg pullback, second leg. It's not enough bars. You want a 2-legged pullback to be somewhat equal to half the amount of bars in the original move. So if this lasts from 8:35 to, let's say, 11:20, let's just say 3 hours, you at least want an hour and a half of sideways to up. And we're barely an hour in. So looks like a leg in the trading range. It's probably going to be more like leg 1, pullback, leg 2. So one thing you can think about is something like this. You wouldn't know that until you got the bull breakout, but if you were long, maybe you bought here, put a stop down here, certainly at least down here. You get the bull breakout, you could say, okay, maybe it'll go up to here. But again, I think the big target is the stop entry. Traders will buy here. They really will. But they're going to use a really wide stop, and they'll buy more above the bull bar. And you notice, I can do this right. Not really a good description, but 50%, so the midpoint, you buy here, you buy more above here, 50%'s here, and you had a little bit of selling. And another part of that is breakout points. Traders buy, scale in, get out of the breakout point. But it's all important. Breakout bar, will we get strong follow through? Nope. So now we have, you can call it a double top with here and here. It doesn't matter. I still think this is not enough for a second leg up for the wedge bottom, 1, 2, 3 consecutive sell climaxes. Doesn't matter what you call it. We need to see 10 bars, 2 legs. This could be a trap, and it doesn't trigger. And there we go. So we're getting a breakout right here, barely any follow through, and starting to go a little bit higher. So now we have a low 2, we're at the target. This is the minimum of what my expectation was. Certainly okay to get out of the longs. As far as going short, it's not the greatest short. It's an okay short, but it's not great. Too many consecutive bull bars, tight channel, and we may have to get closer to the 60-minute moving average. So here's a second entry short. Disappointed bulls bought this close. Disappointed some scaled in lower, got out of break even. And that's the end of the day. One thing I forgot to mention, this is not a good short, and in part it's because of time. It's 2:55, the market closes, the stock market closes in 5 minutes, the futures market closes at 3:15. There's not enough room. It's a lower probability trade because there's not enough room for a swing. So you have to weigh, okay, if you put your stop above the bar, that's 93 to 99, you're risking 6 points. What are the odds you're going to make 6 points before you lose 6 points? Well, and then the other question is, what are the odds you can make twice your risk and make 12 points before the end of the day? And that's not very high. So I hope this video helps.